Hello, everyone, and good morning. Welcome to our DAT IQ Weekly Market Update. This is our update for May 30th, 2023. It's the last one of May, which is my favorite month of the year. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and we have a very special guest this morning. We have Tim Denoyer, who's Senior Analyst over at ACT Research. Good morning, gentlemen.
Good morning.
Thank you for having me.
Yeah. Welcome, Tim.
Thanks for joining. Sorry for the little technical hiccup. As always happens, my VPN decided to disconnect with 1 second remaining in our go live countdown. So everything should be good now. So coming off a busy trade show season, Tim and Dean, I think everyone's maybe resting and recuperating until we hit it hard again this fall. Is that right?
Yep. Yeah.
For sure.
Yes, 3 days was good. 3 days rest.
No, it's been good. It's been good to get out there. Got a lot of really great perspective, and then we kind of gear up and get ready for all of the great events this fall. TIA Technovations, our DatCon event, things like that. So enough of looking forward. Let's not wish away our summer. Let's get into our key points of the week so we can get to our conversation with Tim at the end of the show, because I know that's going to be great. He brought a lot of awesome visuals that we're going to walk through. So key trends that we are watching. Drive-in and reefer spot rates maintain our gains from a couple of weeks ago. It's a really good sign. I will say that there's seemingly a lot of pressure to move back to trend, which will be something really important to watch over this next month. This is a very important month, which I'm sure Dean will cover in more detail, but it's a very important month for smaller carriers in the spot market as they look to bank profit that they can keep them running until things pick up in the fall. Contract rates still cooling. Active rates, drive-ins down 1%, reefers down 2%, flatbeds down 1%. Replacement rates, again, are outpacing that, which is what you would expect, with drive-in down 8, reefer 12, flatbed down 2. ATA tonnage is down about 1.7% month over month and about 3.4% year over year. And then road check week, spot market capacity returns after dropping 16% week over week. With that, I'm going to turn it over to Dean for our market dynamics. Dean?
Yeah, thanks, Ken. We'll do a quick market update today. The long-form version of this week's market update will be available this evening at dat.com/market update, as always. Let's start with our load-to-truck ratio in dry van. Following the surge in volume the week prior, load posts dropped back 13% last week, about half what they were this time a year ago. Equipment posts still very high. They were up slightly at 1% week over week. Load to truck ratio down by about 15% last week from 3.24 to 2.77. In the refrigerated category, following the prior week's volume surge leading to the Memorial Day long weekend, volumes retreated last week. They dropped back by about 21%. Produce volumes are clearly putting a drag on the overall reefer market. Produce volumes are still down about 14% compared to this time last year, which of course wasn't a great year anyway. After reporting a slight shortage of trucks in the 6 produce growing regions in California in the first 2 weeks of May, capacity is loosened now and there's an adequate supply being reported. That's a really important indicator of rate directionality off the West Coast. Load to truck ratio down to 3.93 from 5.25. In flatbed, volume increased by just over 2% last week, but it's been mostly flat since the start of the year. Flatbed market in the spot market categories continues to move sideways. Equipment posts up 5% last week, still the highest level in 7 years. Load to truck ratio down to around 2019 levels at 12.56. Couple of markets we wanted to look at this week. Capacity tightened across the nation in 40 of the 48 states last week. Line haul rates in the top 5 states, California, Georgia, Illinois, New Jersey, and Texas, up 3 cents a mile to an average of $1.88. California outbound dry van rates have been steadily climbing since the start of April, coinciding with the increase in Asian import volumes on the Trans-Pacific trade lane. At $2.09 per mile for outbound California, rates have increased by 30 cents a mile since the start of April. Ontario is a big freight market for dry van carriers. Line haul rates up 3 cents a mile to $1.88. Los Angeles up 4 cents to $1.80. On the long-haul truckload lane that competes with intermodal, Los Angeles to Chicago was $1.31 per mile last week. That's the highest it's been since February, but 32 cents a mile lower than this time last year, and an amazing $2 a mile lower than the high of $3.26 reported in December of 2021 at the height of port congestion and imports on the West Coast. In the refrigerated category, staying on the West Coast, outbound line haul rates cooled off last week, down 4 cents a mile to $2.40, identical to this time in 2020, after increasing for the prior 3 weeks. Outbound line haul rates in the large produce market in Fresno, down 2 cents a mile last week to an average of $2.17, which is almost the same amount carriers were being paid for long haul loads to Hunts Point, New York. In the Brooklyn market, also the highest in 12 months though. Outbound reefer rates in San Francisco market, which incorporates the Salinas Valley produce region, up 5 cents to $2.11 last week. Solid demand for a lot of loads from Salinas to Calgary, Alberta. Spot rates at $2.58, with 30 cents a mile higher on that lane than the April average, but still about $1.70 a mile lower than this time last year. Spot rates in Florida continue to cool at $2.30 a mile. They're down 1 cent per mile last week, almost after being up almost $1 a mile since April. So produce season is definitely cooling off in Florida. And in flatbed, staying on the West Coast again, I've noticed that capacity is starting to cool off on the entire West Coast markets. That's the first time since March we've seen regional line haul rates start to fall. They were down 5 cents a mile last week to a regional average of 242. A lot less volume coming out of Medford last week. That's the largest flatbed market on the West Coast. In that market, rates were down 11 cents a mile to $2.70 for all outbound loads. They've been dropping for about the last 3 weeks. Lanes like Medford to Denver, averaging $2.22. They're about 40 cents a mile lower than this time last year. And wrapping up with our year-over-year look at spot rates, following the prior week's surge in spot rates, dry van line haul rates were up slightly last week, up 2 cents a mile to a national average of $1.71. Based on the volume of loads moved, the average rate for the top 50 dry van lanes was 26 cents a mile higher at just under $2 a mile at $1.97 last week. In the refrigerated section, line haul rates were flat last week for reefer carriers. Remember, folks, these are line haul excluding fuel, maintaining some of the gains from the prior week's surge at 205. Reefer spot rates are just 2 cents a mile higher than this time in 2019. Compared to this time last year, we're about 31 cents a mile lower and about 23 cents a mile higher when we were in 2018. And in flatbed, line haul rates dropped by just over a penny per mile last week, erasing all of the gains of the prior week's surge. At $2.18, flatbed rates remain almost identical to the average from the start of March. So they've been relatively flat for quite a few weeks. So that's it for this week's market update. Remember, if you want to find out more about what's happening in freight, go to dat.com/market update, and you can download our long form version of the weekly report this evening. With that, it's over to Ken for the short-term forecasts.
Thank you, Dean. So these, as I mentioned at the top, are pretty important forecasts. As I said, this is one of the strongest seasonal pushes for the year, culminating typically in the 4th of July holiday. And that's important because it really slows down after that. And I think there's an additional twist here because we don't expect shippers, both anecdotally and through some of the data we're seeing, to pull their ocean volume forward as they have in prior years. So in the past few years, we've all heard about the congestion and things like that in Southern California. There was a potential simmering labor problem this year, which would have caused a lot of shippers to want to de-risk their supply chain at an expense of holding inventory stateside longer. So they pull forward. They would ship on the ocean sooner. And this year, there's really no need to do that. So the reason that's important is it's going to create this longer gap between 4th of July slowdown and the retail shipping peak in the fall. So let's take a look at the forecast. So the blue line here, this is dry van, by the way. We always start there. The blue line is the historical 7-day weighted moving average going back to January 1st. It excludes fuel and it's long haul only. And then we have 4 forecast models. They're a little hard to see because they're sort of pretty much in agreement. Here we have the green line, which is Ratecast, our flagship model. The red is a short-term model, which more heavily weights short-term variables. And then you have a gray and a yellow, which are blends with various mixtures and parameters. And as you can see, 3 of the 4 models are pretty much in exact agreement. It projects a little bit of a cooling for the next week and a half, 2 weeks, and then build up heading into the 4th. The red line's a bit more optimistic. My guess there is it's still seeing it's waiting that artifact of road check week. Again, short-term models don't know that happens every year and smooths it out a bit. It just reacts to what it's seeing. So that's my guess as to why it's a bit more bullish heading into July. Let's go to reefer. So reefer's cooled off a little bit since road check, which is very surprising to me. I mean, Dean laid out a million reasons why that's the case, but it's still surprising to me to see refrigerated going backwards during this time of year. And all the models, again, the various levels, but the shape, they pretty much all agree on. There's a little bit of continued cooling through that second week of June, and then trailing up towards Independence Day. Ending with flatbed, again, a very similar story. So ratecast is on the high side here, pretty much in lockstep with the yellow blended model. And then you have the gray sort of splitting the difference, and then the red line, which is short term, a bit more pessimistic than the others, but all generally following the same shape in a 5 to 7 cent band, which again is always good to see. When you see drastically different shapes, that's always concerning because it tells you there's a lot of volatility in what the models are picking up. So with that, we're going to wrap up forecasting and go to our question of the week and bring Tim back.
Yeah, thanks, Ken. So many questions for you, Tim. But let's start with one of the ones I think you want to talk about. You've got some really good charts to share with us. By how many jobs will the US trucking industry contract this year?
That's an excellent question, Dean. Thank you very much. I think this is a really key question right now because of how intertwined supply and demand really are in the freight markets, and how certainly the spot market is in a loose condition at the moment, but I think the declines in employment that we are seeing are actually start pulling freight into the spot market gradually over the course of this year as the for-hire fleets, which the BLS data really reflect pretty well, as they start to contract. And we're seeing some good evidence that I'll show here that supports that. So we're certainly in what we would call a surplus at the moment, but are you getting my slide?
We see it.
All right. But we've certainly added a lot of capacity over the last couple of years, but in the first quarter of this year, the long distance proportion, part of the market, declined by 8,700 jobs. And that decline in employment was about a 4% annualized rate, which is a pretty sharp contraction. And that's probably continuing, if not getting a little bit larger, given the what's happening with freight rates. And so we think this is going to decline fairly significantly this year. You probably take about 50,000 jobs out of the market from this perspective alone. And this doesn't capture owner operators very well. It does not capture private fleets. This is really just the for-hire fleets. And so there's even greater capacity contraction happening than this. And Dean, I think you've done some excellent work in terms of the operating authorities data. We've recently gotten that from the DOT as well, and our work supports the analysis that you guys have done, that there's another sort of large group of fleets who may not show up in this data set, where we're seeing net revocations of operating authorities. And so we think this is going to keep declining, but other things equal, if you just take the current, you go forward the next 2 months, in June this will be down on a year-over-year basis if it's just flat in the next few months. So we think that the conclusion here is that we're in the process of beginning to swing back towards a driver shortage. It's going to take a while. We don't think it's going to happen until later this year, early next year. But we're in that normal industry cycle where we sort of swing from surplus to shortage, and I would say we're in that surplus still, but we're starting to work it off. And the leading indicators that also support that, of course, are some of the JOLTS data, the job openings data from BLS, which shows that openings for new jobs are down, not down as much as you would think, or as some of the Indeed data are down a bit more, but the separations are up for a while also. So those trends tell us that the declines in trucking employment are going to continue in the near term, and that's going to tighten capacity. And so that broader tightening of capacity, I think, is going to push freight back into the spot market gradually, over the coming quarters. So I think that's the real important point there. And then last one, I'll spend a minute just kind of going through truck orders, because this doesn't relate directly to jobs, but of course, Class 8 tractor orders are always a key topic that we report on a monthly basis, and we think they're going to be soft for several months now, and sort of into through the third quarter of this year. We think we'll be at a 10 to 20,000 unit sort of level. The most recent number was around 12,000 new truck orders. We have the actuals and the seasonally adjusted data here on this slide, and that's just sort of but essentially the same thing that we're seeing on the hiring front. That fleets are basically tapping the brakes, if you will, at this point in the cycle. On capacity growth, and that also sort of sets the stage for that next leg of the cycle.
So Tim, just on the truck orders. Oh, sorry.
Go ahead, Dean.
On the truck orders piece, Tim, I just wonder about, because you've still got a lot of noise in the data from the hangover from the big surge in truck orders late last year, right? So at what point do the year-over-year comps start to lose meaning, or flip side of that is start to regain some of their meaning once that washes out?
Yeah, I think it's going to be a few months yet until they start regaining their meaning. Yeah, I think you're right. That the backlog is about 6 months long at this point, and so that's shorter than it's been in a few years. So that's an important one that we also track, is just the length of the backlog, or the backlog to build ratio, is how we get to that 6 months. And so there's still a lot of orders in the backlog. Replacement demand for equipment is still really strong at the big fleets, who are really well capitalized. I think better than ever in general. Even at this point in the cycle, where they're struggling, they're still performing relatively well if you compare it to prior cycles. And so I think also it relates back to the supply chain constraints of the last couple of years. And so during the strong part of the cycle, where the industry would usually be adding a lot of new equipment, the supply constraints really kept them from doing that. And so we're still sort of catching up a bit on that too. So that timing lag it's working its way through the system. It's like the snake digesting the whatever it's eating. And I think in a couple of quarters that'll be sort of played through, and orders will reflect fundamental demand a little bit better. But in the short term, we're sort of following the down cycle in rates, and I think when rates eventually start picking back up, orders will catch up pretty quickly.
Got it.
I've been kind of honing in when I look at all the capacity that was added and where we need to get from a cycle reversion, numbers kind of hone in between 4 and 7% of total capacity needs to exit the spot market before things start up. And it was really interesting that you stated earlier, I know jobs isn't a perfect proxy for total capacity, but if that's sitting at an annualized change of about 4, it would suggest we've got another 3%-ish more to go. Does that, not to litigate the number specifically, but does that generally track with how you view where we need to be to get back to the next cycle?
Yeah, I think that for hire number is really important. I would say that 4% number I threw out was annualizing just the Q1 number. So it was really only 1% in Q1 that we actually took out. But here, we're halfway through, more than halfway through Q2 at this point, and so we've probably taken out another point or so. I think rates have generally continued down. Particularly on contract, in the last few months, and so that's the one that correlates best with employment. And so I think that that rate's going to get worse. But so it's probably more like a 5% number that I would guess for this year on that for hire employment number. But if you go back to the net revocations of operating authorities, that started to show contraction last October, October 2, and we've estimated something. And Dean, correct me if you're materially different, but something like 11,000 fleets have exited already on net. In that period. And the real question is, what's the average number of trucks per fleet? We don't know. Nationally, it's 8. If you take out fleets above 100 trucks, it's still 6. So a lot of but typically you would guess that a lot of those revocations are owner operators, single truck fleets perhaps. There's certainly some netting happening where some of those fleets are going and working for bigger fleets. Some of those owner operators are letting go of their authority and then moving and working for a fleet. So maybe it's not a net reduction. So all these questions are it makes the DOT data difficult to answer precisely, but directionally, I think we're taking out capacity at a rate that I've never seen before. The revocations are happening faster than they ever have before.
Yeah, they've been tracking at about around two. I just looked at the May numbers this morning. They've been tracking at about a net loss of 2,000 on the longer haul category team per month since November. So it's
I aggregated that, Dean, going back to last October, and it's about 15,000 motor carrier numbers net negative. My hunch, kind of looking at prior things and where we are from a dynamic perspective, that probably has to be like 20 to 22,500, I think, before we really start to see meaningful reversion. That's numbers always going to be out ahead of whatever market dynamics we're seeing, right? So it's no surprise to me that even though May is going to be a better rate in activity month, it's going to be a worse net month. My guess is you see the same in June, and it probably doesn't start flipping positive until later in the year, which will be an entire year in the negative, right? It has to get to October to be it has to cycle itself in October. So, I think that's the thing, though, that it's important to talk about, right? I mean, again, this isn't a shot across the bow or anything, but there's like, if you absorbed all of the content that exists in the world, you'd believe that, it's going to be a Mad Max scenario where there's just power units littered on every highway, east to west and north and south, and every carrier is going to go out of business. But that's really not the case, right? And again, I don't mean to minimize it, because for that 4 to 7% of carriers, it's not good, right? We don't want to see people go out of business. This is their livelihoods. This is their business. But it is still a rather small piece of the total capacity pool that needs to exit, because the spot market is so much smaller than the contract market. So I think it's something to keep in mind that we're looking for very small changes on the margin to have rather large impacts on the market as a whole.
Yeah, Ken, you were talking about the the conference circuit. I was at an investment conference in New York last week, and the key question I kept getting was, well, we're building at a pretty peak production rate of new trucks, so how can rates possibly bottom here? And the answer comes back to our discussion a minute ago of well, a lot of that new demand is for replacement, and we've had sort of a really unusual cycle from a supply chain perspective. So at the end of the day, it does come down to utilize capacity, and if there will be trucks parked, and we are seeing it on the dealer lots and in the used truck market. The values are under pressure, and that's as we would certainly expect at this point in the cycle. But I think this is all really part of the bottoming process, and we do think, by the way, new truck production is going to start gradually ramping down later this year, sort of in the fourth quarter of this year in particular, as a result of those lower orders that I showed. So we'll take some of that sort of new supply, pressure off. I mean, by definition, I don't think it's as much pressure as it usually is, because again, we're just retiring a lot of old stuff that really worked hard during the pandemic. And so, but still, as the new production ramps down, which we think again is Q4 of this year, that also takes some downward pressure off of rates.
Yeah. Well, I think, so many new people entered this market, and there's such high turnover that most folks haven't seen a full cycle, right? It's just kind of, if you piece together all of the data on all sides, there's high turnover on the shipper side, because people get cycled through purchasing for all the different things that they purchase, whether it's hard lines, soft lines, energy, shipping. We know the brokerage industry, especially in the front line, has an astronomically high turnover rate. And then your average truckload fleet, Dean, turns over at 180 to 200% per year?
Probably less than that, Ken. I think a long-term average, probably closer to 100.
Well, the highest.
Okay. I was thinking more on the smaller side, more like a 50 to 100 truck fleet. I know was higher, but yeah, you're probably right. Industry average, I think when I was in my last month that I remember looking at a report, industry average across all fleet size was like 123%. That number sticks out because it was 1, 2, 3. But anyway, so most people, I want to be careful with most because I don't know that to be true. A lot of people haven't seen the ups and the downs, right? They didn't experience 19 on the heels of 18. They didn't experience 17 coming up on the heels of the really slow 15, 16 industrial-driven freight slowdown. So this is new to a lot of folks, is I guess my broader point. And everything Tim said is what needs to happen. Right? The market just doesn't wake up one day and decide, all right, time to start going up again. Like we've had enough of this. We're just going to start going up again. So what needs to happen is capacity needs to exit. You typically see a little bit of a whiplash effect, right, Tim, in the new builds and the new orders, which happens these are all things that happen and I colloquially call it the armpit of the freight cycle on both sides, right? There's certain things that always happen at the very, very top and at the very, very bottom. And we're seeing a lot of those things happening at the very, very bottom that give us indication that we're about to turn upwards. But a lot of them are rather unpleasant, hence the armpit moniker. But I am going to hop off screen here in the next minute. I got to join Samantha Jones for her Meet Me for Coffee podcast, but I don't want to cut the discussion short here. So if you see me disappear, that's why.
All right.
Sure. Ken, let me add onto your point, and as you disappear, but I think another really interesting thing that people who haven't seen a lot of cycles, it can be hard to understand. I got this question a bit last week from sort of people who are studying the industry for the first time. Is that as soon as we get to the point in the demand cycle where inventories stop destocking quite as much, that's more freight. It's a little difficult. It's that second derivative improvement. All we need, so in Q1 of this year, I think I haven't looked at the latest GDP revisions, but it was something like $130 billion negative in the Q1 GDP stats for inventories, which was enormous. Now, if that number declines even at a smaller rate, that means more freight volume. And as we destock less, freight demand will increase. I'm not even saying we need to restock. We will get the other really interesting point is that every time the United States economy, the United States freight economy has destocked, it has restocked. Every time.
Well, Tim, inventory import volumes in April are actually coming in, much higher than I thought. I'm not an expert in that space, but they were up about 16% month over month in April. That would certainly suggest that destocking has run its course. I'm sure there are some commodities, though, where there is still some overstocking that needs to work through. My take on the market is sort of some sectors are up, some are down still. So we still have this bifurcation at a commodity level that really was a feature of the market since the start of the pandemic. That still seems to be playing out in whether you look at food services versus restaurant traffic, whether you look at commercial construction versus residential construction. There's a lot of differences in the market. It's not just all going up or all going down. That's why I think it leads to, your consensus that things are relatively flat on the demand front. But maybe at some point they do start to inflect when we get through all of these imbalances in the market.
Yeah, there's definitely a lot of imbalances. I think your description of the market is right on. You can describe the whole economy right now as sort of a rolling recession. I think that's sort of a valid way to look at things, where some sectors are soft and some are better. And I think we'll be in that type of an economy for a while longer as the Fed works to get the inflation situation under control. And so that situation that process is not over yet. So we think the soft freight market will generally still be with us for a while, but I'm optimistic about next year because as I said, we don't destock for long, and when we do, we restock. And by the way, real disposable income is improving right now because inflation has come down a bit. I mean, we've seen some disinflation, but that has supported recovery in consumer incomes, which also makes me optimistic that holiday spending will just be a little bit better than next year at least.
So great points. You mentioned 2024. But the details are vague, but there's a pre-order contingency you're building into your forecasting around a new emission regulation. Is it next year or the year after? I can't recall.
Yes. It phases in. There's actually still a little bit of a question around California right now. There's supposed to be a CARB low NOx. They call it the omnibus low NOx regulations. which are supposed to take effect next year. They've asked for an extension in the waiver request from the EPA. And so for California to do that suggests that maybe they're reconsidering. EPA has adopted a very similar standard at the national level that will go into effect in 2027. We think there is a little bit of pre-buying happening in California right now. And I think some dealers are going to reposition some trucks towards, some used trucks towards California and the soft market. And I think there's some of that happening that we, right. But we're still not 100% clear about what's happening in 2024. The current rule will be to get trucks to that lower NOx standard, but the manufacturers do need time to plan for these things.
Mm-hmm. Yeah. Before we wrap up, trailer order numbers. What's the latest on both the build timeframe and orders?
As they tend to do, they've trailed, and so they've held up a little bit better than tractor orders, and the backlogs are a bit longer, and we think there is a bit more maybe secular strength, if you will, in the trailer market related to power-only brokerage. And we think that's going to hold the trailer demand up a little bit better than normal in the next several quarters.
We heard some pretty big numbers, didn't we, at your last conference back in April around trailer to tractor ratios and power only fleets. So yes, that's a trend. I did notice just during my travels around the country, again, this is one data point, one person watching what goes on, but there just seems to be more and more trailers in trailer pools sitting around, gathering dust and weeds growing through wheels and things like that. That's not something I would have been able to say a year ago. Same on the 53-foot intermodal box front. Seems to be a lot more assets sitting around.
Yeah, I heard one intermodal company say that they've got a fairly significant proportion of their fleet stacked right now. We're just in that soft part of the freight cycle for sure. Yeah. The power only brokerage point is very long term, and I think it comes back to when things tighten up in these the last few freight cycles and likely in the future, they're tightening more sharply than they have in the past. I think it's related to demographics and a lot of other issues, but certainly the baby boomers retiring is a piece of it.
Yeah, we're in the what they call in the safety world 100 deadly days of summer between Memorial Day and Labor Day. It's a period of time when accidents go up, believe it or not. But the one thing that we've been watching, and Ken made a point on the show a couple of weeks ago, and that is that we're about 14 months into the current downward freight cycle when you measure spot rates going negative year over year. Mm-hmm. The previous three were 17 to 20 months. So if you take the last three freight recessions, we're 14 months into a freight recession that could last another 4 to 5 months, which takes us through the summer into the fall, which typically coincides with that increase in freight volumes, both on the intermodal and the truckload side, leading into holiday season. Is that kind of a scenario that you see playing out, a pretty, tepid summer from a freight demand perspective as the market finds a new level and then starts to tighten, and then we head into the fall and maybe we start to see normal seasonality again?
Yeah. Look, I think that's an extremely reasonable, scenario, and definitely plays to, the history of the cycles. I could make a case that it should be a little bit shorter this time, in part because we didn't add as much equipment capacity. I think the capacity that we added was significant, but it was, we saw a lot of old equipment on the highways the last couple of years that again, needs to be replaced, and so that elevated replacement demand, I think, makes me optimistic that it could be a little bit shorter of a down cycle than the past. Certainly, the sharpness of the down cycle is a piece of the puzzle too, and that will that price signal is what effectively makes the changes to capacity. And I'll share this. It's a little on a personal note. We were driving up to Lake Michigan for the holiday weekend with a camper behind us just a few weeks ago, and I got rear-ended by a Class 8 tractor going 1 mile an hour. It only cost us like 10 minutes. We pulled off. It was my father-in-law's camper, and he just rolled into us. And instead of turning it into a big insurance issue, like it was the tiniest of dents. I figured my father-in-law wouldn't mind too much, and just said no big deal, and shook his hand and said, yeah, have a good weekend.
Wow, good for you.
He did pull over and ask, can we do something about this? Like, it wasn't anything, but father-in-law didn't care.
He was probably doing the ELD creep, right? Staying under 5 miles an hour to stay off duty.
Maybe, I don't know, but he, it was at a traffic light, so yeah.
Okay. All right. Well, Tim, I love having you on the show. You're a good friend of DAT. We appreciate all of the research. A couple of shout outs before we wrap up and come back to you to sort of where people can get in contact with you. Don't forget, Sales Chat is on tomorrow, Day to Day Wednesday. I'm on with Ryan Mohammed and Jeff Dinkinson and Dan Deegan, 11 a.m. Eastern. Robert Rouse is on Landline Now on Sirius XM channel 146 tomorrow night. And coming up on Freightvine, we have Corey Johnson, Vice President of North America Product Supply at Procter & Gamble. They're discussing multimodal logistics, where P&G uses a mix of owned and for-hire warehousing and transport assets. That's Freightvine out this week. So, Tim, a lot of folks probably don't know that you're the author of the CAS Shipments and Expenditure Index each month. Beyond that, how do folks get in touch with you and follow some of your work?
Yeah, thanks. I've been doing the CAS report for a few years now, and but you can always find us at actresearch.net, and we do 2 seminars a year, which we love. We love having you at, and we're looking forward to another one of those in early August. And you can find info on that also at actresearch.net. Yeah,
you've got a pretty good social media game. LinkedIn's always good. I see you guys on Instagram occasionally too, so there's some ways to catch Tim and the team at Act Research. All right, so that brings us to the end of the show. Thank you everybody for watching. Don't forget the long form version of today's market update will be at dat.com/market update this evening, probably around 7 p.m. it'll be up. If not, just send us a message to askiq@dat.com. Thanks everybody for watching. Have a safe week.
Thanks, Steve.